Good morning, ladies and gentlemen, and welcome to the show on this Thursday, the 22nd of July, 2021. Thank you for tuning in. Listen, I'm glad to have you guys here. Now, here's what I want to say. There's an awful lot of talk, about deflation and inflation. And, for you guys, a lot of people, it's confusing. You think, well, where should I put my money? Should I pack it into dollars? Is everything going to deflate? Should I go out and buy gold and silver because maybe everything's going to inflate? And you start to get nervous and you start to wonder, what am I going to do? Well, you have to look at the big picture here. And as looking and examining the economy on a macro, see, you're not right in there looking close down in the forest. You're up above. It's like a painting going to a museum, And if you're looking at a painting from only 4 or 5 inches away, or if you're looking at a painting from, say, 30 feet away, this is the difference between getting in real close to whatever market in the economy. Say somebody is a microeconomist, and they're right in there looking closely at the pricing of one particular market. They're not seeing the overall economy. With macro economics, you're looking at it from a distance so you can see the overall picture, and you're not so concerned with the smaller details. You're seeing what direction is this really going? You know what I mean? And the direction this is all going ultimately is inflation. The part that's transitory is these small deflationary periods that we might go through on our journey to ultimately inflation, because it's the way the system is set up at its core. It's set up that they constantly have to keep expanding the monetary supply. And what does this mean? Well, let's get in there and look at the charts, and I'll explain. Start the charts right here. Here's an article I just saw this morning on Yahoo Finance. It says we have 8 million saved for retirement, and we are in our early 50s. We want to retire early, but are worried about healthcare expenses. What can we do? Okay. Well, I'm going to tell you what. When I was growing up as a young guy, if you had $8 million, if you say so-and-so's got $8 million saved, you wouldn't look at them like first off, this article is looking at these people who have saved $8 million like they are just Bill and Sally that live down the street, like middle class. Back when I was growing up, a young guy, if somebody had $8 million, they weren't middle class. They were rich. In fact, filthy rich. And this is the way it was when I was growing up, Now, $8 million, you're not really rich anymore. You're just upper middle class retirement money, And this is where we've come just in the past 30 or 40 years. This is this slow trudge toward inflation. And ultimately, if we move into the future, say 10 years or whatever, $8 million, people will say, well, I got to go to the grocery store this afternoon. I got $8 million, and I'm not sure I'm going to be able to buy everything on my list. That's what $8 million is going to do. And this is a given. This absolutely has to happen this way, because we're slowly trudging toward. Now, we might have these little deflationary periods, but that's the transitory. That's transitory. That's the part that's transitory. The inflation is not transitory. It's ultimately going to continue until its end, when the dollar's worth zero. But by that time, they'll have something new. Probably central bank digital currency, as this is the direction they're going. They don't want you to be able to remove your money from the bank. They want you to be trapped in the banking system. Your money's there. Right now, listen, guys, you can still make a withdrawal from the bank. Right now. And if you got $8 million and you're sitting on it right now, you're going to lose Guaranteed. You're going to lose about 5% of that this year. Well, that's a lot of money, you know? And that's a guaranteed loss, too. Now, it's actually probably more like 10% you're going to lose. But I'm saying 5% because that's what the CPI is right now, according to oil. What it really is in excess of 10%. So you're going to lose 10% of your money. That means that you got $8 million saved for retirement. You're having it go out, your purchasing power go out the back door quicker than you've been saving it. It probably took you how many years? What did it take this couple here to save $8 million? Probably took them most all their lives. Maybe he's a doctor, maybe she's a lawyer. Probably took them their whole career. 30, 40 years to save that much money. And right now, at 10% inflation, $8 million, it means that they're going to have what? 10% of that go out the back door? That's faster than it's coming in the other side. In other words, it's leaking out. This is the same thing as if you're going down the highway and you got a leaky tire and the air's leaking out of it faster than you can keep putting air in it. Get into something else. Something that'll preserve your purchasing power. And then you can sit back and you know that at the end of the day, your $8 million is still going to retain $8 million purchasing power. This is what you have to do to protect your wealth. And yeah, these little deflationary periods might make it, these asset classes like gold and silver in particular, it might make them look bad at times. Because you get a little bit deflationary period and the price actually goes down on the spot price and stuff, But look at gold and silver's track record over the last, I don't know, say 80 years. It preserves your purchasing power. And it'll continue to do that where these fiat currencies won't preserve your purchasing power. And right now we're in one of these little periods where gold and silver are suffering. That's the best time to make this transfer over from the regular financial system, and they're failing slowly failing currency, into something that, when you look out 10 years in the future, will double and triple and keep up with inflation, where your fiat's going to still be worth the same as it's worth now. Fiat, I mean these dollars that they create from nothing. Anyway, let's get into the markets and let's take a look at what's going on with gold and silver today. We got it going up right now, 3 cents up on the silver price, 25.26. Now, it's only 3 cents, but we'll take everything we can get with this because we've been having a hard time with this the last few months. 25.26 for silver today. Let's take a look at gold today. 1803 today, so it's up 60 cents. Gold and silver have been suffering now for quite a little while in price. I think that what we're looking at is I don't think the gold and silver price are going to go down that much from where they are right now. I think that most of your you have to take a look at downside potential and downside risk, I should say, and upside potential when you're considering these, And your downside risk in gold and silver are low. And your upside potential is enormous. So you got to take that into consideration. Take a look at cryptocurrencies today, 1313. And we're looking at a Bitcoin price of 32,214. So, Bitcoin's probably going to be a big mover next year. I think that the rest of this year, I think that Bitcoin's going to suffer. But I think sometime next year, I think the next bull run's coming in cryptocurrencies. And, as long as they're suffering along like this, the tensions come off. Like the governments and everything out there were talking about, we got to do this with cryptocurrency and don't put your money in cryptocurrency and everything because you could lose all. That's what the government says, to you. And the thing is now you notice they're being more quiet about it because now cryptocurrencies aren't ripping to the moon anymore. It's basically become a backstory. So that this whole thing that it's, in other words, it's just like being in the trenches in World War I. You stick your head up out of the trench, you're making yourself visible and everything. That's what Bitcoin and cryptos were doing back when the price was surging higher. Now that it's dropped back and everything, and the excitement's down and everything, it's like it's pulled its head back down into the trench again. It's safe for now, I think, pretty much, and it's going along, and it's going to go along like this until it goes into the next bull rally. That's when it's going to pop its head up out of the trench. Who knows what'll happen? Anyway, let's take a look at the Dow Jones today. 31 points down, and it's at 34,766 today. Boy, I'll tell you, this thing hasn't been going anywhere, up or down. It's ready for a crash, but they're not going to let it crash very far. And so if it starts to crash, and this is what I'm expecting, I'm actually expecting it to start to crash sometime between now and the first 6 months of next year. And I've said this quite a few times on my channel. That's when I'm expecting it to start to crash. What we're going to see is they're not going to let it go very far before they step in and do something. Know exactly what they'll do. One of the things is they can't let interest rates go up now any. On the long end, the whole yield curve, they can't let interest rates go up. And I mean, it's getting tighter and tighter all the time. They could withstand like 2% on the US 10-year just a couple months ago. Now they got to keep that down, probably below 1.5. It's getting worse. It's getting so the economy now will only run if interest rates are extremely low. And they can't let them go up. The whole house of cards will come down. And so, we're looking at this crash coming up on the Dow. They're not going to let it go very far before they do something. And what they'll probably do is something called yield curve control. Or on the long end of the yield curve where they actually control and they don't let the interest rates go up. So how long, I mean, we've been in a bond market rally now for what, 30, 40 years, How much longer will it continue? It's not going to end. They're going to have to control it. They're not going to, they cannot, this whole thing, this house of cards that they've kept running since 2008 until now, they can't let it come down now at this point because the whole thing will just crash down like a house of cards, right down flat. And they can't let that happen. Let's take a look now at crude oil. It's at $70.61. It's up 31 cents on the day. The MOVE index, 65.28. Looks like it's peaked a little bit there. Let's take a look at bonds and rates today, and we're looking at falling yields. We're looking at a 10-year at 1.25. It's fell 2.5 basis points, and the U.S. 30-year at 1.9. And it's fell 2.2 basis points roughly. So long end's fallen today. Let's take a look now at the U.S. dollar index. 92.78. Had a little dip there, but it's going along sideways. The ultimate conclusion, guys, in all this is don't let the static or the noise fool you. And that is deflationary periods, because those will be transitory. Ultimately, where we're going is inflation. And the dollar is going to keep trotting along as it's going. And, if we get a big crash and they come in and rescue everything, it's just going to make the inflation come faster. If the markets melt up, which can happen, it's just going to make the inflation come faster. If we get the markets and they go along level like they've been going along, that's going to be the slowest for hyperinflation. It's going to take longer for the hyperinflation to get here. So in other words, if they can keep this system that they got going, and through their mechanics of financial engineering, if they can keep it roughly stable, like they've been doing, it's going to take longer for the hyperinflation to get here. If we have a crash, it's going to come sooner. And if we have a melt up, it's going to come sooner. But it has to. Listen, I've covered all three bases there. It has to do one of those three things. Either the markets have to melt up, or they have to melt down, or they have to stay stable. There's no fourth option there for what the markets are going to do. And we just covered all three options. The slowest option for the hyperinflation to get here, to drag it out as long as we can, is for the markets to stay stable like they've been roughly doing for the last number of months. So if they can keep this stability in the markets, they can push the hyperinflation off quite a long way. If they can keep the volatility down through financial engineering. And maybe they'll be able to do that. And in that option, you know, I might be on here like you guys, if they can do it that way. I might be on here next year, and you guys will say, you said their hyperinflation was going to be 2022, and it's not here yet. If they can keep this stable, it could drag out longer. You know, I'm betting on instability. And then we'll have our hyperinflation in 2022, especially if we get a crash. That's the way it is, you know. Ultimately, the road to hyperinflation, it's ultimately going to happen. It's a question of timing. Thank you guys for listening. Like and subscribe, and we'll catch you guys in the next show. Bye-bye.